Hey everyone, welcome back to the channel. Today we're diving into one of the most controversial and fascinating topics in finance: how billionaires pay less in taxes than ordinary Americans. You've probably seen headlines about the ultra-wealthy paying lower tax rates than teachers, nurses, or small business owners. But how is that even possible? Isn't the tax system supposed to be fair? Well, not exactly. The truth lies in the way the rich earn, report, and legally minimize their income. So, let's break down exactly how billionaires play the tax game and why the average worker can't. First, let's understand the key difference between how billionaires and regular people make money. Most Americans earn income through wages, meaning you work, get paid, and then pay taxes on that paycheck. Billionaires, however, earn most of their wealth through assets, things like stocks, real estate, or businesses. These assets grow in value over time, creating what's called unrealized gains. And here's the loophole: those gains aren't taxed until the billionaire actually sells them. So, while your paycheck gets taxed immediately, their wealth can grow tax-free for years or even decades. This strategy is the cornerstone of what many call the buy, borrow, die system. Here's how it works. Step 1. Buy appreciating assets, like shares of a company. Step 2. Borrow money using those assets as collateral. Since loans aren't considered income, they're not taxable. Step 3. Die and pass those assets to heirs who receive them at a new, higher, stepped-up basis, effectively erasing decades of tax liability. It's a perfectly legal cycle that lets billionaires live off borrowed cash while avoiding income taxes almost entirely. To see how big this loophole is, let's look at an example. Suppose a billionaire owns $1 billion worth of stock that increases to $2 billion. That's a $1 billion gain, but they don't owe a single dollar in taxes until they sell it. Instead, they take out a $100 million loan against that stock to fund their lifestyle. Because loans aren't income, there's no tax bill. Meanwhile, the average worker earning $60,000 pays taxes every paycheck. It's the same system, but completely different rules depending on how your wealth is structured. Another advantage billionaires use is the capital gains tax rate, which is much lower than the tax rate on regular income. While middle-class wages can be taxed up to 37%, long-term capital gains, profits from selling assets held for more than a year, are taxed at just 15% or 20%. That means when billionaires finally do sell something, they pay far less in taxes than a typical employee. The system rewards people who make money from investments rather than labor, creating a huge gap between the rich and everyone else. But that's not all. Many billionaires don't just rely on low capital gains, they also use loss harvesting to offset their profits. This means if they have investments that lose value, they can sell them at a loss to reduce their taxable income from gains elsewhere. They can even carry those losses forward into future years. For example, if a billionaire loses $10 million on one investment and gains $10 million on another, they can cancel each other out and owe nothing in taxes that year. It's perfectly legal and extremely effective. Then there's the carried interest loophole, one of the most criticized provisions in the tax code. It allows hedge fund and private equity managers to classify their income as capital gains instead of ordinary income, cutting their tax rate roughly in half. So, even though they're earning money for managing other people's investments, they pay less in taxes than the people who clean their offices. Every time Congress talks about closing this loophole, it sparks huge political debate. But so far, it has survived every reform effort. Another tool in the billionaire tax toolbox is depreciation. Real estate moguls use this to deduct the supposed wear and tear on buildings, even if the property is actually appreciating in value. By claiming these paper losses, they can drastically reduce or even eliminate taxable income. For example, a billionaire landlord might earn millions in rent but pay little or no taxes because they're writing off massive depreciation expenses. This strategy was famously used by several billionaires, including former presidents, to legally report little to no taxable income. Charitable foundations are another powerful strategy. Many billionaires donate their wealth to foundations they control, taking large tax deductions up front while keeping influence over how the money is spent. Technically, they give it away. But in practice, they often use foundations to fund causes that benefit their businesses, reputations, or political interests. The foundation pays no income taxes and the billionaire gets a deduction. It's philanthropy, yes, but also a highly strategic form of tax management. Let's not forget about trusts and offshore accounts. Billionaires often place their assets in complex trust structures that shield income and delay taxation. Offshore entities in places like the Cayman Islands or Bermuda can further reduce tax exposure by routing profits through countries with low or zero taxes. It's legal when structured properly, though often controversial. Meanwhile, the average American doesn't have access to these financial tools. They're filing W-2s and hoping for a small refund each April. Another big reason billionaires pay lower tax rates is that they can afford the best tax. Attorneys and accountants money can buy. These professionals specialize in finding every deduction, credit, and loophole possible. For middle-class taxpayers, the cost of such services wouldn't make sense. But for billionaires, saving even 1% on taxes could mean tens of millions of dollars. Essentially, the rich have a financial system working for them, while everyone else has to follow the standard playbook. You might be wondering, if these loopholes are so obvious, why doesn't the government close them? The truth is, tax reform is politically complicated. Many of these laws were written with the intention of encouraging investment and economic growth. Lawmakers argue that lower taxes on capital gains or business income promote job creation. But over time, the ultra-wealthy learned how to use those same laws to minimize their own taxes without technically breaking any rules. It's legal, but it's also deeply unequal. Data backs this up. Studies by ProPublica and the IRS have shown that the effective tax rate, what people actually pay, drops dramatically at the top. Some billionaires have paid income tax rates as low as 3% or even less. In 2018, for example, Jeff Bezos paid zero federal income tax. Elon Musk and Warren Buffett have also had years with minimal tax bills. Meanwhile, the average middle-class worker pays around 24%. That's the irony. The richer you are, the less percentage you pay. The issue isn't just about fairness. It's about how wealth compounds. When billionaires pay less in taxes, they keep more money invested, generating even more untaxed gains. Over time, their wealth skyrockets, while ordinary workers lose more of their income to taxes. That's why the wealth gap continues to widen even in strong economies. This isn't simply a moral problem. It's an economic one that affects social mobility, opportunity, and the long-term stability of the middle class. So, what are policymakers proposing to fix this? Some have suggested a wealth tax, which would tax assets like stocks and real estate even if they're not sold. Others advocate for raising the capital gains rate to match income tax rates or taxing unrealized gains for the very rich. There's also talk about closing loopholes like carried interest or tightening rules around offshore shelters. But these proposals face intense opposition from powerful interests, and implementing them would be politically and logistically challenging. Critics argue that raising taxes on billionaires could hurt investment, entrepreneurship, and job creation. Supporters, however, believe that fairer taxation would reduce inequality and fund essential programs like healthcare, education, and infrastructure. The debate continues, and the outcome could reshape America's financial landscape for decades. What's clear is that the system, as it stands, heavily favors those who build wealth through ownership rather than labor. The middle class bears most of the tax burden, while billionaires use legal strategies to minimize theirs. So what can ordinary taxpayers do? While you can't borrow millions against stock portfolios, you can learn from the wealthy's approach. Focus on investing, not just earning. Use tax-advantaged accounts like 401ks, Roth IRAs, or HSAs. Take advantage of credits, deductions, and long-term investment strategies. You might not have billionaire wealth, but you can still apply some of the same tax-efficient principles on a smaller scale to keep more of what you earn. In conclusion, billionaires pay less in taxes not because they cheat the system, but because they understand it better than most. They use the laws strategically, investing in assets instead of earning taxable wages, and borrowing instead of selling. Whether you think that's smart or unfair, it highlights how the tax code favors wealth over work. The key for the rest of us is to stay informed, plan wisely, and push for a fairer system. Thanks for watching, and don't forget to like, share, and subscribe for more videos on money, taxes, and financial power.